Imagine you are standing in front of a small American house. It has 2 bedrooms, a narrow porch, a patch of grass, and a price that looks possible. You walk into a bank and ask for a mortgage. The banker looks at your savings. Then he tells you something that would sound shocking today. You must pay nearly half the price yourself. The bank will lend you the rest, but the loan may last only 3 to 5 years. During that time, your payments may cover mostly interest. They may reduce only a small part of what you borrowed. When the loan ends, you may still owe most of the original debt. The bank demands that remaining amount in one payment. This is called a balloon payment. Most families cannot produce that much cash at once, so they need another mortgage to pay off the first one. That is called refinancing. If no bank agrees to refinance the debt, the family may lose the house. Today, millions of Americans use a very different kind of mortgage. They make regular monthly payments. Each payment covers interest and reduces part of the debt. The loan may continue for 30 years. If every payment is made, the balance eventually reaches zero. This feels completely normal today, but it is not an ancient system. The modern American mortgage grew out of one of the worst economic disasters in the country's history. So how did people buy homes before the 30-year mortgage became common? Why did banks offer loans that ended after only a few years? What happened when millions of homeowners needed refinancing, but banks stopped lending? And how did a government program created in 1934 begin changing American homeownership? Before the Great Depression, buying a house was much harder than many Americans now imagine. Mortgages already existed. Some longer loans also existed. But there was no large national system offering ordinary families the familiar fixed-rate long-term mortgage used today. The terms depended heavily on where the family lived. They depended on the local bank or lender. They depended on how much money the buyer had saved, and they depended on how safe the lender believed the borrower and property were. For many buyers, the first major obstacle was the down payment. A bank might lend only around half of the home's price. A family buying a $5,000 house might need roughly $2,500 in cash. At the time, that was an enormous amount of money. Families sometimes saved for years. Some received help from parents. Some borrowed from relatives. Some bought land first and built a house slowly. Some made a private payment agreement directly with the seller. And many continued renting because they could not save enough. Before the Great Depression, fewer than half of American households owned the homes in which they lived. Even families that found the large down payment faced another danger. Many mortgages did not slowly pay off the full debt. The family might pay mostly interest for 3 or 5 years. Then the loan would end while a large balance still remained. The family was expected to refinance. A new mortgage would pay off the old mortgage. Then, a few years later, the family might need to refinance again. This system worked while banks were willing to lend. It worked while people had jobs. It worked while homes held their value. And it worked while lenders believed they could recover their money if a borrower stopped paying. The entire system depended on new credit remaining available. That was the weakness. During the 1920s, American cities expanded. New neighborhoods appeared. Cars allowed families to live farther from work. Builders constructed more houses. Home loans came from banks, insurance companies, private lenders, and building and loan associations. These local associations collected savings from members and used that money to provide home loans to other members. They helped many families, but the mortgage market remained local and uneven. A family in one city might receive reasonable terms. A similar family somewhere else might face a much shorter loan and a much larger down payment. There was no single national standard. Then came 1929. The stock market collapsed. Businesses failed. Factories slowed or closed. Millions of people lost their jobs. Thousands of banks failed during the early years of the Great Depression. Families that planned to refinance suddenly discovered that banks were no longer willing or able to lend. Imagine the trap. You have made every required payment for several years, but your short mortgage has reached its final date. You still owe a large part of the money you borrowed. You ask your bank for a new loan. The bank says no. You ask another bank. That bank also says no. Perhaps you have lost your job. Perhaps your wages have been reduced. The value of your house may also have fallen. The balloon payment is due, but you cannot pay it. You may have followed every rule and still lose the house. When a borrower cannot repay a mortgage, the lender may foreclose. The lender takes control of the property and tries to sell it to recover the unpaid money. During the Depression, foreclosures spread. Families lost their homes. Banks received houses they did not want. Banks needed cash, not thousands of empty properties. But there were fewer buyers. Many houses could not be sold easily. As more homes entered the market, prices fell further. A bank might have lent $4,000 on a house now worth only $3,000. Selling the house would not return all the bank's money. This weakened banks and made them even more afraid to lend. The housing crisis damaged the banks, and the banking crisis made the housing crisis worse. When Franklin Roosevelt became president in 1933, the country was facing an emergency. His administration did not create one single solution. It introduced several programs, each designed to solve one part of the problem. One early rescue program was the Homeowners Loan Corporation. Congress created it in 1933. It helped homeowners who could not get new loans from private banks. The corporation could replace a dangerous short mortgage with a new loan that charged less interest and gave the family more years to repay. Instead of facing one giant payment immediately, the homeowner could make smaller payments over a longer period. Those payments also reduced the debt little by little. The program did not save every homeowner, and it was not yet the modern 30-year mortgage, but it gave many families more time. It also revealed an important truth. A responsible family could lose a house because the mortgage itself was badly designed for a national crisis. Helping people with existing loans was not enough. America also needed a safer system for new home buyers. Banks were frightened because property prices had fallen and foreclosures had caused heavy losses. When a bank looked at a young family, it saw risk. What if the family lost its income? What if the house became less valuable? What if the bank had to take the house and could not sell it for enough money? Banks wanted protection before lending widely again. Without new mortgages, fewer families could buy homes. Without buyers, builders would construct fewer houses. That meant fewer jobs for carpenters, plumbers, electricians, factory workers, and many others. The federal government then made a much larger change. On June 27, 1934, President Roosevelt signed the National Housing Act. The law created the Federal Housing Administration. The agency did not normally lend money directly to homebuyers. Private lenders still made the mortgages. The government insured qualifying loans. If a borrower stopped paying and the lender suffered a covered loss, the insurance reduced that loss. This changed the calculation for banks. With less risk, lenders could accept smaller down payments. They could offer longer repayment periods, and they could provide more predictable monthly payments. The Federal Housing Administration helped make mortgage rules more consistent. It supported loans in which every payment reduced part of the debt. Early federally insured mortgages were often around 15 to 20 years. Over time, 25-year and 30-year mortgages became more common. So the 30-year mortgage did not suddenly appear in every American bank in 1934. The important change was that the new law created the insurance and standards that allowed long-term mortgages to become normal. Now compare the two systems. Under the older system, the buyer might need half the home's price in cash. The loan might end after only 3 to 5 years. The payments might reduce very little of the debt. Then a large balloon payment could become due. If the family could not refinance, it could lose the house. Under the newer system, the down payment could be smaller. The loan could continue for many years. Each payment could reduce the balance. The family could see a clear path from the first payment to full ownership. The monthly payment became easier to manage because the debt was spread across more years. But the borrower also paid interest for a longer period. That was the trade. The buyer received more time and a smaller monthly payment. The bank waited longer to receive all its money, and the government reduced part of the bank's risk. One more problem remained. A local bank did not have unlimited cash. After making many long-term mortgages, much of its money became tied up in those loans. The borrowers would repay it slowly over many years. The bank needed a way to recover cash sooner so it could make more mortgages. The answer came in 1938. The federal government created what later became known as Fannie Mae. Fannie Mae could buy approved mortgages from lenders. A local bank could make a mortgage and then sell that mortgage. The bank received cash. The family continued making the same payments. But another institution now owned the loan and received those payments. The local bank could use its returned cash to lend to another family. This helped create the secondary mortgage market. That simply means a market where existing mortgages are bought and sold after the original lender has already made the loan. This system kept money moving back toward local lenders. They no longer had to wait decades for every borrower to finish paying before making more mortgages. The modern system was taking shape. Government insurance reduced lender risk. National standards made mortgages more predictable. Longer repayment periods lowered monthly payments. Regular reduction of the debt removed the giant balloon payment, and the secondary market returned cash to lenders so they could make more loans. After the Second World War, the system expanded further. Millions of service members returned home. Many married and started families. New suburbs were built outside cities. Government-supported loans for veterans and a larger mortgage market helped more Americans finance houses. By 1960, more than 60% of American households owned their homes. The long-term mortgage became part of a common American life plan. Get a steady job, buy a house, make one payment every month, build equity, and ideally, enter retirement with the mortgage fully paid. But the new system did not treat every American equally. The Federal Housing Administration helped make long-term mortgages safer and more widely available. Its policies also helped strengthen redlining. Redlining was the practice of marking certain neighborhoods as dangerous for mortgage lending. These judgments were often based heavily on race. Many black neighborhoods and racially mixed neighborhoods were labeled risky, even when individual families had stable jobs and enough income to pay. A qualified black family could be denied a safe mortgage because of the neighborhood where it wanted to buy. At the same time, government-supported mortgage money flowed more easily into many white suburban communities. This gave many white families a better chance to buy homes that later increased in value. Many black families were denied the same opportunity. Because homeownership is one of the main ways American families build and pass down wealth, unequal access to mortgages helped widen the racial wealth gap. The mortgage system opened the door to homeownership for millions, but it also helped keep that door closed for many others. The 30-year mortgage changed more than access. It also changed how buyers paid for a house. A longer loan spreads the debt across more monthly payments. That usually makes each payment smaller than it would be on a shorter loan. But the borrower stays in debt much longer. The borrower may also pay far more total interest. A 30-year mortgage does not make a house cheaper. It changes when the buyer pays the cost. Instead of paying a very large amount at the beginning, the buyer makes hundreds of smaller payments over much of adult life. That can help a family buy a house sooner, but it can also commit a large part of the family's income for decades. Still, a modern fixed-rate mortgage gives the borrower something the old balloon loan often could not provide: predictability. The interest rate remains fixed. The basic principal and interest payment does not suddenly rise because market rates have increased. The family does not face one giant unpaid balance after only 3 or 5 years. It does not need to find a new bank every few years simply to keep the house. Each payment moves the balance closer to zero. So how did people buy homes before the 30-year mortgage became common? Some paid cash. Some saved for a very large down payment. Some borrowed from relatives. Some used local building and loan associations. Some made private agreements with sellers. Some accepted short mortgages and hoped a bank would refinance the debt later. And many could not buy a house at all. The modern mortgage did more than give Americans additional years to pay. It allowed families with steady income but limited savings to enter the housing market. It changed how much risk banks carried. It gave the federal government a major role in housing finance. It helped support the growth of suburbs. And it made homeownership an important measure of financial success in American life. Today, when a lender asks whether you want a 15-year or 30-year mortgage, the choice sounds normal. You compare interest rates. You compare monthly payments. You calculate the down payment. You may never ask why a bank is willing to wait 30 years to receive all the money you borrowed. The answer is not that banks simply became patient. The entire system was rebuilt. Mortgage insurance reduced some of the lender's risk. Standard rules made loans easier to evaluate. The secondary market allowed mortgages to be sold for cash. Government policies and agencies supported important parts of the structure. Because these systems work together, a local lender does not always have to keep the same mortgage for 30 years. The modern mortgage was built step by step during a national crisis. First, short mortgages collapsed when families could not refinance. Then, emergency programs replaced some dangerous loans. Federal insurance reduced the risk of making new mortgages. National standards made those mortgages more predictable. And a national market allowed existing mortgages to be bought and sold. Each change solved a different problem. Together, they created the system that now feels normal. The next time you pass a house with a for sale sign, look at it differently. The average family's ability to buy that house depends on more than wood, brick, glass, and concrete. It also depends on mortgage laws, insurance, banking rules, government agencies, and financial markets. Before the 1930s, many buyers had only a few years before a large unpaid balance became due. Today, that same debt can be divided across 30 years of monthly payments. That is, the trade inside the modern American mortgage. The older system demanded much more money at the beginning. It also placed the family in danger when the short loan ended. The newer system gave the family more time and a clearer path to full ownership. That extra time changed who could buy a home. It changed how families built wealth, and it changed America.